Asia. Have a look at that big pop you're seeing on Japan's Nikkei 225. Remember, it was closed yesterday, so really missed that rally. And we are seeing Japanese stocks now at January highs, so close to gaining back to where we saw at the end of 2021. SoftBank certainly an outperformer today. We once again heard about the offload there from Masayoshi Son of the Alibaba stake, and that is lifting SoftBank shares to their highest since May. Also looking at the Malaysian ringgit, up by about 1/10% there. We talked earlier about the GDP in that country coming through as a beat with 8.9% growth year on year in the second quarter versus estimates of 7%. And elsewhere, we're seeing a pretty downbeat day when it comes to the bond market. So yield on Australia's 10-year note up by some 11 basis points there, Manus.
And in Hong Kong, the GDP is out later. Of course, we're just seeing the beginnings of the easing on quarantines. That won't come through on any of this data on this occasion. So how brutal will it be?
Yeah, absolutely. So year on year, we are expecting a decline of 1.4% for Hong Kong second quarter growth, and quarter on quarter potentially a little bit of upside of 0.9 of 1%. But a Bloomberg survey suggesting you may not see any annual growth for Hong Kong this year. And certainly we were speaking to Fitch earlier on Bloomberg Radio. They don't think that the reduction in quarantine is really going to change the dial too much, because are you going to see business travellers or tourists coming to Hong Kong if they still have to spend 3 days in quarantine? We've also, of course, got this story that we are tracking. If we flip the board and have a look at my chart, about Hong Kong's population continuing to decline. It has fallen by a record 1.6%, more than 120,000 people leaving the city in the past 12 months. And that is the third straight annual decline, leaving Hong Kong's population at around 7.3 million. Manus.
Jules, thank you very much. A sad fact in terms of the exodus Judith Salida in Hong Kong. Well, Bloomberg is reporting that Egypt is considering raising about $2.5 billion in a loan from regional and international banks. This is the economic pressures on the country intensifying. Simone Foxman is in Doha. She's tracking the story. Simone, good to have you with me. So Egypt already has pledges from the Gulf states. Some people are saying they potentially were topping out. They may turn to, we know, the IMF. I caught up with the finance minister on that. So why would they need to turn to the banks in addition? Is it in addition to everything I've just outlined?
That's certainly what it seems like, Manus. And the reality is that Egypt's financing needs are extensive, and the prices it would pay to borrow in the market on a bond basis would be extremely elevated. We are looking at more than $40 billion in external financing needs by the end of 2023. So yes, Egypt has gotten money from Gulf states, but a lot of that money is not necessarily directly going into government coffers because it's been devoted to investments. Yes, Egypt is likely to get an IMF loan. Goldman Sachs predicting that loan will have to be something in the realm of $15 billion. Egypt doesn't want it to be that high. When you look at the market option, when you look at where bonds are trading, we're looking at 2027 bonds at just over 80 cents on the dollar. That's a yield of about 12%, or actually 13%, but we had seen yields a little bit higher, up as much as 16% just earlier this month. The reality is that whatever Egypt does in order to fill its coffers, be able to meet these external financing needs, it's going to be pricey.
It sure is, and certainly in the commercial market at 13% for Egypt, it's lumpy. Let's talk about Turkey, because we're seeing a landmark investment from the UAE here into top officials there. What are the details on that?
Yeah, this is the first major investment by an Abu Dhabi-based company since ties really warmed back in the past year between the UAE and Turkey. They've been very negative for a while. And it's being done by IHC, International Holding Company. That's the most valuable company on the Abu Dhabi Exchange, and it has very close ties to the National Security Advisor of the Emirate. That they are buying a 50% stake in what's called Kalan Energy. This company itself, as parent, has very close ties to the Turkish government, and in fact has been criticized for winning certain contracts. Clearly here, we're looking at a dialogue between the UAE leadership and Turkish leadership. We've seen previous pledges. This appears to be some of them maybe coming to fruition. President Erdogan in Turkey really needs foreign money at the moment. So this is something that he's likely to welcome as an investment in the economy as he faces his own economic struggles.
And also in Turkey, we've got some pretty punchy data out today on the industrial production. So what's expected there?
Well, we expect industrial production to remain flat on a month-on-month basis, but it's going to significantly decelerate, according to economists, on a year-on-year basis, down from 9.1% in May to an expected 6.7% in June. This has been an indicator that has remained very strong on the back of those low interest rates. Remember, President Erdogan has been trying to keep those rates low, juice the economy, and keep that going, even despite the pain of inflation. So if, for some reason, industrial production were to slow down significantly, that would be an indicator that his plan is not necessarily working. This is a number we have to keep in mind ahead of a central bank meeting next week. Of course, we expect the low rate program, this unorthodox monetary policy, to continue. But one more thing traders are going to keep in mind.
Okay, Simone, thank you very much. Simone Foxman there at the Qatar Financial Centre in Doha, keeping us abreast of all the moves throughout the week. So we've had the key measure of US producer prices unexpectedly falling in July. Now, that's the first time in more than 2 years, largely reflecting a drop in the energy prices and representing a welcome moderation in the inflation pressure. Meanwhile, San Francisco Fed President Mary Daly says she's open to a 75 basis point hike at the end of the month, in next month's meeting. Let's get the implications for our region on fixed income markets. Doug Bitcoin is the head of credit strategies at Rasmala. So, Doug, we see this rolling over in CPI and PPI. It's amazing how we started the week with Citi calling for a 100 basis point hike, or not calling for. They raised the flag of a risk of 100 basis points. People were talking about an inter-meeting move. Where are you on the conviction level as you go to the close of the week about the risk of much more aggressive hikes from the Fed?
Well, I think that the CPI number was obviously a little bit lower than the market was expecting, but one swallow does make a summer, and it's a start. There are some underlying trends in that CPI number. Rent is still going up. You still got food inflation there, so we don't see this as a material change from our position in terms of our conservative stance on duration. I think the Fed is not going to be reducing rates in 2023. They will continue to raise rates in 2022 and into 2023, and they will hold it for an extended period of time. So I think this notion that we're going to see the Fed start to reduce rates in April next year is fanciful.
Well, if that's fanciful, then talk me through why you think the bond curve managed to re-steepen yesterday. And it did so quite aggressively through this week. We went from -58, the deepest inversion since 1982, and we're at -34. Valerie, the Queen of Charts, and myself were talking this morning. Well, no, man, it's because people basically think the Fed will go slower, they'll tolerate slightly higher inflation, and so you have this slightly re-steepening. 30s move by 15, 10s move by 10. I'm struggling with that. Can you explain the re-steepening for me, just overall, and then we'll talk about our market?
Yeah, well, that inversion was being driven by
recession
and that. Yeah, right. So this is what people are looking at, and now they're saying that, well, maybe if the Fed doesn't move so slowly, then they don't move as quickly and as aggressively, then the risk of recession is less. So therefore, you have this re-steepening of the curve.
Okay, I'll sell you that. Okay, you can have that by the bucket from me. GCC bonds have done pretty well.
Yeah.
We've returned 7%. You have a conservative outlook. You were surprised by Oman and Bahrain. Do you think that they've got further to run? You say they've outperformed recently, but can they continue to outperform?
Yeah, so if we look at the performance of the high grade versus high yield over this long duration, over the last since the end of June, we've seen a strong outperformance by Bahrain and Oman. And normally, when you get a decline in oil prices, you see these credits underperforming. But it was really driven by the risk on the return of liquidity to the market. They were, I think, people are still looking for yield now. There's been quite a bit of tightening in the market.
Does that spread continue to tighten? Then the JP Morgan, the spread over treasuries, you've had that move, but we've had this move across all markets. But does that spread tighten up further?
I think that we're probably getting into a position now. We need to see actual inflation coming down, and we need to see economic activity actually, less concern around a recession. And I think if we see less concern around a recession, we could continue. We'll trade around these kind of levels. But I think we're going to see risk on, risk off, and this is really what you've got to trade in the range.
As far as this region is concerned, I mean, these are the inflation. We've taken some prints from around the region, from obviously Saudi and the UAE being two of the biggest. Do you think we're inflation slightly delayed, and the next narrative you and I and the rest of the bond people in this region talk about is an acceleration of our inflation because we've lagged the rest of the world?
Well, we have seen inflation definitely in the UAE pick up strongly. We're sitting with inflation in Dubai near 6%. And where's that been driven? That's been driven by rent. I don't see our landlords reducing rent prices anytime soon.
No, Doug, don't make an enemy of the landlords here. No, take break Middle East.
But this is the reality, is that these inflationary pressures are still here. Inflation in the region has been protected to some extent by the subsidies that we've seen on fuel prices.
It's interesting, though, the affliction of inflation has really only been felt here in the past couple of months. It might have been building up in the pike, but it really only came to bear in the past couple of months. That's why I say the real peak of our inflation is yet to come. You still have some big calls, some perpetuals out there that you like on Majid and ADNOC, etc. You're still very much committed to those positions on Majid Al Futtaim. They're at the shorter end of the curve, though, aren't they?
Yes, well, Majid Al Futtaim, they've actually just did a tender offer of their perpetuals, their 5.5% perpetuals, and they have called the remainder of those perpetuals, and those will be repaid in September. They've issued some new perpetuals. Now you're going from 5.5% up to it's more than 8% that you're getting now. We think that you're being well compensated for taking that risk.
Okay, long and large in Majid Al Futtaim. Doug Bicon, Head of Credit Strategies at Rasmala Investment. Thanks for being with me this morning, right here on your Friday edition of Daybreak Middle East. This is Bloomberg.
To be able to give our customers vehicles, that are their primary vehicles, that are EVs, and to be able to do that, we need to have range and infrastructure, and we need to remove the pain points. And so that's what we're doing.
This is a market that, over the past few weeks, has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical potentials are rising.
San Francisco Fed President Mary Daly says the cooler inflation reading for July may mean a 50 basis point hike at the central bank's September meeting. But she told Bloomberg that the fight against price pressures is far from over, and the policymakers must keep watching the data.
the scale of 50-75 doesn't just depend on a data point, even an important one like the CPI. I like to say that we're data dependent, we're not data point dependent. And so really how I think of whether it's going to be 50 or 75 is I look at a lot of things coming in. So we have inflation numbers coming in, we have employment numbers coming in. We actually spend a lot of time, I know I do and my colleagues do, talking to businesses, households, community groups, people in stores. What are you feeling? And are you seeing signs that the economy is slowing? So all of those things, when I put them together, global risks, global growth, I have a baseline case going into September that is 50 basis points. That's where I've been since the last meeting. But I have an open mind about whether 75 is going to be necessary. And a lot of that will depend on the labor market, inflation, and whether we start to, we see those things slow enough to say, wow, we've got the momentum we need to really fight inflation.
But 50 or 75 isn't about pivoting. It's not about ending this rate hike path. So I'm still kind of curious, if you just were looking at those numbers, what would you say? Did they support your baseline, for example?
So 50 or 75?
Yeah.
I think 50 supports the baseline. Think of where we need to be at the end of the year.
the numbers we just got.
Oh, the numbers we just got? The numbers we just got say that we have enough uncertainty about the path of inflation. It looks a little bit improvement, but we don't want to be head fake, so we want to wait for the next report. We have an inflation report and an employment report coming out before the next meeting. It really behooves us to stay data dependent and not call it. But for today, with those numbers in hand, I still think 50 basis points is the case, but I am open to 75 should the data evolve differently.
So we've got another inflation report, another jobs report.
We do,
big ones. Now, I want to ask you, I want to hit some of the big points first. And the other one is, there's, in terms of recession and recession risk, there seems to be frequently a sense in markets that, oh, once there's signs of a recession, if the risks are rising, the Fed will pull back. So is the Fed, are you willing to let those risks materialize if you have to risk a recession, if that's what it in the end takes to get the inflation rate down?
Well, I'd like to start with this. We are a long way from evaluating those risks. Right now, look at the employment report. The people in the labor market, whether they're a firm trying to find a worker or workers trying to find a job, do not feel like it's a recession. Right now, jobs are plentiful. The main marker for consumers about a recession is, are they finding a hard time finding jobs? Is it hard to get a job? And are their incomes falling? And you really don't see that right now. So I don't see the risks of inflation as our preeminent risk. I see the most important risk we face in the economy as inflation is too high and has been too high for too long, and we need to bring that down. So when I'm balancing the risks, I'm really balancing how quickly can we bring inflation down without tipping the labor market over, and that's why 50 basis points makes sense to me right now.
Mary, does the stock market bullishness right now, is that challenging to the Federal Reserve, given that, of course, that could relax financial conditions, which is not what the Fed wants to see at this moment?
So we look at a broad range of financial conditions, and the stock market is simply one of them. I'm also looking at mortgage interest rates and borrowing rates for businesses and consumers for a variety of things. And I really do want those to remain tight and tightening as we go, because we don't want financial conditions to relax. We want them to remain tight so that we can continue to bridle the economy somewhat, take the accommodation out. Remember, financial conditions have been so loose in part because we were adding a lot of accommodation to get us through the pandemic. Now we want to pull that back, and we want the economy to slow, bring demand and supply back in balance, and deliver a sustainable growth path that delivers on price stability and full employment. This is achievable, but it takes some time to work its way through.
Mary, it's not the ideal scenario, but would you ultimately be comfortable or okay with triggering a recession, even if it's a mild one, in order to get over inflation?
Well, let me just say what is true is that I think about what I want to achieve, what Americans really are expecting us to achieve, and that is a smoother transition that doesn't require a recession, actually delivers on a slower economy that is still giving people the jobs they need and the price stability they deserve. That's what I'm looking for, and that's what I'm focused on 100%.
San Francisco Fed President Mary Daly there with the Bloomberg team right here on Bloomberg.
No one covers the world like Bloomberg.
There's a sense of get to 7% in the coming months. Do you see that coming through?
There was something of a grey zone battle between Taiwan and China.
Where are the job cuts to come from? We will not just cut and run.
With unmatched reach and resources from more than 120 countries. The moment news breaks, 24 hours a day. Bloomberg, your global business authority.
We get the UK GDP figures in just over an hour, and the economy probably contracted in the second quarter. So let's get to our London HQ. Leanne Gerrans is there tracking the data. I mean, how bad will this be? Will it be restricted to certain parts of the economy? Good morning, Leanne.
Manus, good morning to you. And as you just said there, we are expecting the UK economy to contract in the second quarter. All that data out in about an hour's time. And the contraction will be due to the decline in health output that we are seeing. Also, there's less retail sales. And remember, back in June, we celebrated that bank holiday for the Platinum Jubilee. Now, that is likely to have really affected activity. And this is all according to a survey from Bloomberg economists. But we are likely to see a rebound in the third quarter. But really, Manus, that is where the good news ends. And that is because we're going to be seeing these soaring energy prices coming up in October. So there's lots to account for, but we are likely to see a contraction of 1.2% in an hour's time when all those figures drop.
And Leanne, where are we on the hustings between Rishi Sunak and Liz Truss? And I ask you that because there is this debate about whether we'll see more windfall taxes on the energy companies.
Manus, so I think there's 6 hustings that have happened, and the one was in Cheltenham last night, but we've got another 6 to go, so there's 12 altogether, so halfway there. But what we have to focus on is the BOE is really focused on getting inflation under control, but it seems that Rishi Sunak and Liz Truss are still sort of having this fight over windfall tax. Liz Truss has completely ruled out a windfall tax on energy companies, where Rishi Sunak is saying it would be considered. But yesterday, the Prime Minister, Boris Johnson, he's obviously ruling a caretaker government at the moment, met the big bosses of energy companies to try and come up with a solution. But he's saying there isn't one, and he's not going to put in one until a new Prime Minister is put in place on the 5th of September. So what this means is households are now anxiously awaiting to see what could happen. And also the BOE is so focused on bringing down inflation. What it means is they're going to have to wait for a new Prime Minister to come into power in order to see if their fiscal policies will help bring down inflation in the future. There's a lot of uncertainty at the moment, and I think a lot of people are concerned that their energy bills could soar significantly in October.
And I think, you know, just to coin what Liz Truss actually had to say, she said, I don't think profit is a dirty word. In fact, I think it became a dirty word in our society is a massive problem. And maybe this is where the divergence in terms of that sort of Thatcher-era mantra from Liz Truss comes through. I got to say, Greg, the producer on this show, is a mighty fine lad. He ran all the way to the kitchen. There you go. No more coughing. We're done. Leanne, well done. It's amazing. You kept talking and he kept running, and we got there.
And you
Leanne,
kept
thank you very
coughing,
much.
but I hope you feel better soon.
I kept coughing, but you didn't take the hint. I will give this to you. You just kept going. That's what I like about you, Leanne. There's nothing going to stop you.
I hope you feel better,
at home in London. We'll be grand. We've got the water now, the elixir of life. Leanne, thank you very much. Leanne Garrans in London HQ. We'll bring you those GDP figures as they cross the tape. We survived. We got there. We got to Friday. We didn't break anything. Well, not yet. Equity markets this morning are trying to reassess what does the steepening of the curve really mean. My guest this morning, Charles-Henri Monchot, is, of course, looking at the US equities up by 0.25% this morning with a cautious level from upgrading their equity outlook from unattractive to cautious. NASDAQ has had a 20% rally. Are they deluded? Have the bulls just become deluded? Is it time to pause for thought? Because this Fed is not for turning. I'll have a glass of water and I'll take you through the next hour. It's beautiful in London.
My grandfather got into the mutual fund business because the average investor could not get a diversified stock portfolio, and it was too dangerous to put, your entire savings in just a couple of companies. So the mutual fund was created to give a diversified expert management at a reasonable price. Today, we have a phenomenon where companies are waiting much longer to go public. And so in 2000, the average company went public after 3 years. Now, companies are waiting 9 to 10 years because there's so much money available in the private markets. As a matter of fact, they're half the number of public companies that there were in 2000, and they're 5 times the number of private equity-backed companies. So just from an investable universe, you look at the private markets, and it's significantly bigger. So the question is, that return that used to be captured in the public markets is now captured in the private markets. But the problem, as you know, is you're really tied up for a long time when you invest in a private equity fund. And so trying to figure out a way to solve the same problem my grandfather was trying to solve, which is how do you bring those returns responsibly, the democratization of the private markets to the retail investors. And I describe it as a bit of like running with scissors. This is a great tool if you use it appropriately. And so we're focused on trying to figure out responsibly bringing it into the average investor.
We will never break. We will never break. Build on a foundation strong enough to stay. We will never.
Good morning from our Middle East headquarters in Dubai. I'm Menace Crenny. This is Daybreak Europe with the stories that set your agenda. A key measure of US producer prices unexpectedly falls. The Fed's Mary Daly isn't ruling out a 75 basis points hike next month.
I have a baseline case going into September that is 50 basis points. That's where I've been since the last meeting. But I have an open mind about whether 75 is going to be necessary.
The US Attorney General says he personally approved the search of Donald Trump's residence. The Washington Post reports the FBI was looking for classified documents relating to nuclear weapons. And the UK GDP is set to drop in the next hour. Expectations for a contraction of the economy. That is the battle for Prime Minister continues to rage between Liz Truss and Rishi Sunak. A very warm welcome to the show, 6 a.m. in London, 7 a.m. in Frankfurt and Paris. We kick off with the equity market risk. And Seema Shah, a principal global advisors, makes it very clear. Bring out the big guns. Take some of the hot air out of this market. That's what she's saying. Bring out the big guns. Powell needs to speak to the market. Equity markets are a little bit higher this morning. There's a deep misunderstanding about the risks that are out there. So you have the S&P 500 eking out the smallest of gains, up an eighth of 1%. The Nasdaq is up 20% from its lows. I can tell you, as far as equity market risk is concerned, nearly $3 trillion has been added from the nadir on the Nasdaq. So the battle of the bulls is there. The equity markets, they're raging. But of course, the bears have the grip at the longer end of the Treasury market. Euro Stoxx 50 flat, and the DAX, the price of power. If you think you're going to work from home for the winter of 2022, 2023, you're wrong. The price of power in France, in Germany, in the United Kingdom will drive people back to the office in their droves. We need to start talking about that in terms of the overall economy. Let me show you what's going on in the bond markets and the dollar. The dollar is down for 5 days in a row now. We're down. Oh, there you go. We'll come back to that in just a moment. By the power of technology, I take you back to the DAX. We're flat on that. We'll run through the cross assets in a moment. I can tell you this: the bond markets around the world are lit up. Aussie rates are spiking higher as well. We'll come back to those in just a moment. The team out there, Mark Cranfield is covering the bond market. It's global. Lizzie Burden is covering the UK GDP numbers. They're coming up shortly. And Bruce Einhorn has the latest developments for the search of the Trump residence. Juliet Sally is looking at the Asian market wrap. So let's get into these producer prices. They unexpectedly fell in July for the first time in more than 2 years, largely reflecting a drop in the energy costs, representing moderation, let's say, of inflation pressures. Meanwhile, you've got the San Francisco Fed President Mary Daly saying she's open to 75 basis point hike next month.
I have a baseline case going into September that is 50 basis points. That's where I've been since the last meeting. But I have an open mind about whether 75 is going to be necessary. And a lot of that will depend on the labor market, inflation, and whether we start to, we see those things slow enough to say, wow, we've got the momentum we need.
Mark Cranfield is with me for the MLive team. So, Mark, it's been a huge week. Start of the week, 100 basis points being floated by Citi, inter-meeting hikes being floated by everybody. Here we are, you know, the great plausibility factor. What did you make of Daly's comments?
Well, I think if anyone's worried that the markets are not really going to be awake as to the risks in the next few weeks, they only have to look at what Mary Daly had to say. I think the next few weeks are going to be very choppy, especially for bond markets. And by saying that she is open to 75 basis points, but she sees 50 as the base case, that's not what markets want to hear. They want to hear clarity. They want to know what the Fed hike is going to be going into the meeting. So we're going to have 5 weeks of uncertainty. We're going to have other Fed speakers who will probably be something like Daly, where some of them will be already looking for a big hike, some looking for a smaller hike. Markets will be chopping around quite a lot as each Fed speaker steps up to the plate, and each data point suddenly becomes more important as well. So this morning when Mary Daly was speaking, we saw Treasuries initially sell off, then they recovered, and it's already been quite a lively session. And Asia is usually very quiet on the Treasury front. So that's what we can expect in the weeks going ahead, particularly in the US time zone, where the Treasury market obviously is the big daddy and it pushes around all the other markets. So bond traders are not going to relax. Between now and the Fed meeting, there are going to be lots of bumps along the road, and every single data point could tell them something different.
Exactly. And today, you know, Michigan Friday, we're going to get those inflation expectations out of the 10-year part of the curve. We're expecting those to come in sub 3%. That will imbue a new level of volatility today. Mark, thank you very much. We'll see you a little bit later in the show. To the UK, we've got more data points to come on the growth side. The GDP for the economy probably contracted for the second quarter, hit by an extra bank holiday for the Queen's Jubilee in June. Lizzie Burden is there with what we can expect. Lizzie, this is going to be a reading. You were all on holiday partying for the Queen over that long weekend. How bad will it be?
Well, economists surveyed expect a 0.2% contraction. And as you say, it's largely because of this bank holiday that we all enjoyed in June. June is expected to see a 1.2% slowdown in growth. And really, it's because when you have a bank holiday, you turn a weekday into a weekend. You lose the most productive parts of the economy. But what's interesting is that because we didn't have a bank holiday in the third quarter, you'll likely see an upswing from the second to the third quarters. And that means in the UK, we're not going to have 2 consecutive quarters of negative growth, which means the Queen has kind of saved us from a technical recession for now. But you'll remember when the Bank of England had its meeting last week, it foresaw these 5 consecutive quarters of slowdown. And so this bank holiday is saving us from that for now.
OK, Lizzie, we'll dig a little bit deeper into these numbers as we go. 5 quarters expected on recession. Let's see how deep it is for today. Lizzie Burden at London HQ. Well, the FBI has searched Donald Trump's home to look for nuclear documents. That's according to the reporting from the Washington Post. Meanwhile, the Attorney General, Merrick Garland, said he did approve a decision to seek a search warrant for Trump's residence and is asking a judge to unseal the warrant.
I personally approve the decision to seek a search warrant in this matter. Second, the department does not take such a decision lightly.
Let's bring in Bruce Einhorn. There was a further step forward, wasn't there, in that he wanted to unseal the warrant and what they find. And we've had a response from Trump. Bruce, good morning.
That's right, Manus. So the Attorney General, he doesn't have the ability to unseal the warrant and unseal the receipt. This is the document that the agents gave to the people at Mar-a-Lago when they finished the search. He had to ask a judge to unseal it. The judge won't do that without permission from former President Trump and his team. Just within the last hour or two, we've had a statement from former President Trump on Truth Media, Truth Social, his social media site, saying that he would not oppose this. The former president also said that in his statement, I'm going a step further by encouraging the immediate release of those documents, encouraging in all caps there. So it seems like we are going to get them. It's worth noting that the former president has had these documents since the search and has the ability to release it himself. Unlike Merrick Garland, he doesn't need anybody else's permission. He has them. So one way or another, it seems like we are going to get these documents. One word of caution here is that the one document that we're not going to see is the affidavit that was filed with the court in order to get the warrant. The affidavit is what likely has a lot of the details behind what it is that they were searching for. We may not get that much more in the warrant and in the receipt, but we will be getting some information. And final point is, as you mentioned earlier, the Washington Post reported that among the documents that agents were looking for when they were at Mar-a-Lago, they were looking for things related to nuclear weapons. We don't have any further details about that. Washington Post is just citing people familiar, saying that these were things related to nuclear weapons. We don't know if these were American nuclear weapons, other countries' nuclear weapons, whether or not the agents were able to get these documents. All that is still unclear, Matt.
Okay, let's see how the news flow goes through the day. Bruce, thank you very much. Bruce Einhorn there in Asia, covering the Trump story. Japanese shares are powering ahead on the MSCI Asia Pacific Index today. Traders returning from holiday. Juliet Sani has the ramp higher and the context. Jules.
Hey, Manus. Yeah, we are on track for a fourth weekly gain on the regional benchmark index, and that is the longest winning streak we have had in terms of weekly gains since January 2021. And as you say, it is all thanks to Japan playing catch up to that rally we saw across Asia yesterday when its market was closed. The Nikkei now at January 2022 highs. A little bit flat on China's market coming off of those gains that we saw yesterday, but on track for its first weekly gain in 6. And the Malaysian ringgit is rising after we had a very impressive second quarter GDP beat. The economy there rising 8.9% in the quarter over the year. That is the fastest pace in a year. Let's have a look on what we're expecting from Hong Kong in a couple of hours' time, because it's a very different picture there. We know a lot of the COVID headwinds and global headwinds, of course, really weighing into this economy, expecting year on year the economy to actually contract by 1.4%, and some, according to a Bloomberg survey, suggesting we may not see any growth in Hong Kong at all for 2022. These COVID issues, of course, leading to a brain drain. Let's have a look at my GTV chart, because we actually saw Hong Kong's population decline 1.6% in the past 12 months. 120,000 people leaving Hong Kong, leaving the city's population at 7.3 million people, and this is the third straight annual decline that we have seen. Of course, Hong Kong grappling with a number of issues even before the pandemic. Manus.
Absolutely. Jules, thank you very much. Julia Sali, firmly in Singapore there. Thank you for the roundup. Coming up on the show, we're going to talk markets, the inflation, the rolling over of CPI and PPI, and the Fed's response with Muzinich's co-head of public markets, Tatiana Grail-Castro. She joins me shortly. This is Bloomberg.
A digital-first approach to the future of work is where the industry and all companies will be heading.
Could the future of work not be at home or in the office, but in the metaverse instead?
There's that word, metaverse.
Doing well. How are you doing?
When I think about the metaverse, I think about immersive experiences that have a sense of active presence.
Wow, look at this. This is me. The metaverse is projected to become over $1 trillion market by the end of this decade. And whether you know it or not, you'll probably be working there in the future.
We're moving into a world where we're going to be interacting with computers with our bodies.
This is definitely trippy.
I think the adoption curve is going to be slow.
It's
doing
weird.
Like a weird floaty thing right now.
Oh, look at you. You have no legs.
It's kind of a fun world, and we're just at the very beginning of a very long journey.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question. Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Markets are completely ignoring Fed speakers right now. They don't want to hear it.
Are they fighting the Fed?
I think they're fighting the Fed, but I think you always need to bring the big guns out. We need Powell to come out and speak. So until he speaks, I think the market rally can keep going.
Punching it out for reality. Principal Global Investors Chief Strategist Seema Shah there on the recent rally in stocks. Tatiana Grail-Castro is with me, Portfolio Manager, Co-Head of Public Markets at Muzinich & Co. I don't envy your job at all. This is probably one of the most unloved, mocked rallies that I have lived through. I just hope my pension is invested. So let's get your take. Seema Shah says, bring out the big guns, bring out Powell, bust this myth, bust this rally. What do you reckon, Tatiana? A rally built on sand?
Yes, it is very difficult, as you say, at the moment. And we are scratching our heads also because we say, how can it be that the market is reacting in the way it does? And I personally come out a little bit in the middle where I say the bond market is too negative. So anticipating recession too much, thinking that central banks will turn very quickly. And we don't see it that way. We do think that central banks are focusing on inflation and they have more runway than the bond market is currently allowing them or sort of expecting them to have. Contrary with the equity market, yes, we have seen an enormous rally over the last month, but we are also still down year to date. So, and that is similar to spreads, how I'm thinking about spreads, actually. So yes, the rally has felt very strong over the last few weeks. But I think then if we sort of say, oh, the equity market is completely wrong, then we have forgotten what the equity market went through for the year. And what we have been thinking about since the beginning of the year, pretty much, is recession. So we have thought about inflation, we have thought about the recession, we have thought about the supply chain issues, we have thought about the war in Ukraine. So all this should already be in the market. And so now to go and say, well, the equity market is ignoring it all, they may have already anticipated, or you can see they've already anticipated a large part of it, and they are now aligning themselves to say, well, actually, the recession may be further out, it may be shallower.
Tatiana.
So I think we're in the middle.
Yep. Okay, we've got a lot to unpack. You see, we don't have great memories, do we? We just want to shine a light on the July rally of 9% when everybody was getting ready to go to the south of France. Now they're in the south of France and they've still missed this rally. Talk to me what you think positioning is like out there, because there is a sea change. The job of equity markets and equity fund managers and portfolio managers like you is to make a big call on allocation. Do you think if it's much maligned, it's under-owned, the turn in equities? Let's start there briefly, the positioning.
Mm-hmm. Okay. In terms of positioning, yes, people may not have. So I think I want to turn it around. So the positioning, I don't think is as short or sort of not participating in the rally as you may want to imply. With the rally over the last few weeks, it is just I think that the spirit has changed. So this animal spirit from fear has turned very strongly to greed, and that's really what's driving it. So marginally, investors are very reluctant to sell anything, and marginally we want to buy, and so. Even on the margin, is there is such a reluctance to such a desire to hold on to every asset that you have, it makes it very difficult then, to find a seller, and that's really what's jumping things up. So I don't think the positioning is extremely conservative, but conservative, and everybody's holding on to their assets.
I like the line that you put forward there in terms of we may be moving from this deep-seated fear, which is where we were. We were gripped by fear at one juncture in the implosion of these equity markets, to maybe a little bit of greed. Now, talk about the credit markets, because in the end of the day, maybe people aren't selling their equity assets. You talk about the credit markets, and I think it's interesting. There's lots of stories on the Bloomberg this morning about maybe it's time to be cautious and step into credit. You say there's going to be some spread widening ahead of the end of the year, but it's not going to be that drastic. Again, it's almost like sort of like warm porridge from Goldilocks, isn't it? There's not going to be an explosion or a retesting of the highs in high yield credit. Is that your base case scenario for credit markets?
I would, yes, actually. I think you summarized it very nicely there, where, again, the credit market generally anticipates a recession by about 18 months. So we have already seen the spread widening. And clearly now we have seen a rally, which, again, felt very strong over the last few weeks. Mm-hmm. But it only felt so strong because clearly we had this almost unprecedented widening in yield. Now, not necessarily in spreads, but in yield, because clearly interest rates went up significantly while credit spreads widened. So all in, we had a significant widening in absolute yield. And now we see some of that coming back. And again, I think it's very similar to what we mentioned with regards to the equity market, where we have already priced in a lot. So the volatility that I'm sort of anticipating towards the end of the year is really because I agree with the speaker you have highlighted earlier, Siba, where she says, well, actually, the bond market is pricing in too early and too much of a recession. And so to the extent that because we have seen this early in the year, central banks spoke, the market didn't listen. Then all of a sudden, the market listened to the central banks and interest rates went higher. And now we're in a period again where the market says, well, actually, no, we know what's going to happen. The central banks, you don't know, the recession is coming. And now we have this period again where the market is not listening to the central banks. And I have a strong feeling that before the year is out, the markets will listen to what central banks are saying, and therefore rates are going higher. And that could cause more volatility.
Tatiana. Indeed, I think there's a hearing aid problem, isn't there, across a couple of these markets. Tatiana, thank you so much. Tatiana Castro, portfolio manager. Yeah, exactly. It's a bit like how I reckon the producers of this show, the co-head of public markets over at Muzinich & Co. Thank you very much for being with me this morning. Coming up on the show, China's Belt and Road Initiative has resulted in almost $1 trillion being spent on infrastructure across the globe since 2013. We take a look at the impact on Kenya right here on Bloomberg.
There is an epic saying in Italy when it comes to family generations that the first generation creates, the second generation expands, and the third generation destroys. And that's almost what happened in the Gucci story.
So hate and love together.
Now I would have a much more experience about those who says I love you and then betray you.
The Gucci family was the strength, but also the weakness of the label.
The situation became dire with Gucci's finances. They were not able to pay salaries. They were not able to pay suppliers. Gucci's really teetering on the brink at this stage.
We have to be able to give our customers vehicles, that are their primary vehicles that are EVs, and to be able to do that, we need to have range and infrastructure, and we need to remove the pain points. And so that's what we're doing.
China's Belt and Road Initiative has scattered almost $1 trillion into infrastructure investment across the globe since 2013. And some of that money has gone right here in Kenya, specifically this Nairobi Expressway, which just opened in August. The toll highway runs about 27 kilometers through a city with notorious congestion problems. Its cost, almost $600 million, entirely designed, financed, and built using Chinese funds. But the bigger project is the railway. The standard gauge railway runs more than 350 miles from the capital of Nairobi to the key port town of Mombasa, funded by a $5 billion loan from Export-Import Bank of China. A Chinese firm had operated the railway, but this year Kenya Railways took over the project with the aim of reducing operating costs by 50%. The worry, though, is that it may not actually be profitable for some time. For many, these projects are welcome, especially in a nation much in need of infrastructure development.
There's been great progress on road infrastructure across East Africa, and that's making it easier for us. It's making it cheaper for us, or more cost efficient, to deliver our brands across the patch. So I would say the transformation we are seeing on road infrastructure is good for business.
And money from China has flowed freely across the continent with fewer strings attached than funds from the West. But the financial terms of those deals remain a secret. China is Kenya's biggest trading partner, 3 times as big as the U.S. And in the run-up to the elections, we heard both candidates stress the fact that China is important to the economy and will play a part going forward. But that position remains controversial, especially with growing calls for more transparency about these deals and growing concern about debt.
Bloomberg Quick Takes Jennifer Zabadaja reporting from Nairobi on the impact of China's Belt and Road Initiative on Kenya. Let's get the first word news. Juliet Sally's with me in Singapore.
Hey, Manus. Bloomberg has been told President Biden is getting ready to launch his re-election bid after November's congressional midterms. It sets up a potential 2024 rematch with Donald Trump. Polls suggest most Democrats would prefer a different candidate. Those close to Biden say he's committed to stopping Trump from returning to the Oval Office. The frontrunner in the race to become UK Prime Minister has ruled out levying a new windfall tax on energy companies if she wins. Liz Truss said doing so would send a wrong message to businesses, international investors and the public. Her rival, former Chancellor Rishi Sunak, promised to find up to another £10 billion to help people pay for soaring energy bills. South Korea's president has cleared the heir to the country's biggest company of bribery charges. The move gives Samsung Electronics Vice Chairman J.Y. Lee the right to work at the firm. Lee spent 18 months in prison before his release on parole a year ago. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Manus.
Jules, thank you very much. Juliet Sally there in Singapore. Coming up, we're going to dig into the oil markets. We've enjoyed a pretty big week of a rally, up over 5%. What are the factors driving that? And just how deep is the European energy crisis? We'll discuss that with Christoph Ruhl. This is Bloomberg.
Record-setting temperatures, deadly forest fires, receding rivers. In this episode of Bloomberg Green, we're focusing on extreme weather. We'll explore the science behind the recent heat wave.
It's going to get more extreme than it is now. I'm afraid that's inevitable.
The consequences of extreme weather.
There is overall low awareness that heat kills. And until recently, there's not been as much effort to try and educate people about the dangers of heat.
And solutions for the planet to mitigate and adapt.
We need government to lead on this, and we need government to stimulate, regulate, and stop certain things happening.
I'm Kaylee Lyons from Bloomberg's global headquarters in New York, and don't miss this week's edition of Bloomberg Green, airing this weekend on Bloomberg TV, Quick Take, and online.
Wherever you get your news.
This is Bloomberg Daybreak quickly.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Good morning from our Middle East headquarters in Dubai. I'm Manus Rennie. This is Daybreak Europe with the stories that set your agenda. A key measure of US producer prices unexpectedly falls. The Fed's Mary Daly isn't ruling out a 75 basis point move next month.
I have a baseline case going into September that is 50 basis points. That's where I've been since the last meeting. But I have an open mind about whether 75 is going to be necessary.
The US Attorney General says he personally approved the search of Donald Trump's residence. The Washington Post reports the FBI was looking for classified documents relating to nuclear weapons. And UK GDP is out in the next hour. Expectations are for a contraction in the economy, that as the battle for Prime Minister continues to rage between Liz Truss and Rishi Sunak. Well, oil prices are headed for their biggest weekly gain in 4 months, following interruptions in supply. Speculation that fuel switching will guide the demand trajectory. Goldman Sachs are predicting further rises. Brent is seen at $130. US gas back at $5 by the end of the year. Not what the White House will want to hear. Stephen Styczynski talks me through the bullish week that was. Stephen, good to have you with me. Supply constriction, geopolitical neurosis, what drives us this week?
Yeah, absolutely. I mean, it's a bit of both, isn't it? You know, you've got some issues in the Gulf of Mexico. Some output is offline. It's not a lot of output, but it's enough to get the market spooked. The market is tight, so that's seeing a bit of a price increase over the last few days. On top of that, you had fears that Russia was going to cut supply via pipeline to Europe. And while that didn't come to fruition, it was a short outage. It did cause fears of, hey, you know, there is still this risk, the Moscow risk and Russian supply risk that will keep markets kind of swinging up and down. Then you had the IEA come out and say that natural gas prices in Europe, they're at the highest level for this time of year ever. It's very expensive for generators of electricity, so they're going to be switching most likely to oil to generate electricity. And that's how they generated electricity decades ago. That was one of their main sources of power production, but they switched to gas and also more to coal due to reasons either being more expensive or because they wanted to curb output of emissions. But they're going to be switching back to oil, and that will be help increase oil demand through the end of the year, according to the IEA. But then OPEC Plus came out with a report and said, hey, no, you know, we could potentially see an oversupply of oil this quarter. So there are a lot of different signals, but we are beginning to see a more bullish trend after weeks of sell-off.
It'll come down to just whether the global economy slows and whether China reopens. Those are the other two big demand side aspects of this equation. Stephen, thank you very much for setting the table. Stephen Styczynski, our energy reporter. Joining me now is Christopher Rule, Senior Research Scholar at the Centre on Global Energy Policy at Columbia University. Joining me now. So, Christoph, good to have you with me. You were listening in to Stephen there. Here we are. I've got the IEA saying demand's going to ramp higher by 2 million barrels. And then I've got OPEC telling me I'm going to pivot into a surplus in this quarter. Can you marry these two for me?
Yeah, I mean, this is a market which is more confusing when you look to the different pronouncements, when you listen to the pronouncements of actors, you know. And traditionally, the IEA sort of ramps down its demand figures, and OPEC now does the same. I think what we have here is underlying, number one, there is no shortage of oil. Underlying, number two, despite everything we have seen, wars and recession fears in China, and there are still safety walls in the system. There's still strategic petroleum reserve. There's still shale production possibility to increase. There's still spare capacity in the Middle East. There is still OPEC countries which are either under civil unrest or under sanctions and therefore can't produce. So there are these safety walls which can be activated by political will. But we have to recognize, and that together accounts for a drift of oil prices over the medium term, which should be down, which makes me agree with both the IEA and OPEC, which both say that supply will exceed demand in the third quarter and for the rest of the year.
But all those little taps, SPO, they're not little, are they? SPO, Iran, Libya, Nigeria, which are obviously you're reluctant to name countries. I have no problem.
No,
and you've got Saudi spare capacity and Emirati spare capacity. All of these incremental turns are restricted by politics.
Exactly. So they can be switched on and off by politics. That's what I was trying to say. That's why I call them safety walls.
Okay.
There's an underlying current of supply exceeding demand for the rest of the year, which would make for a downward drift in prices, which we're seeing. We're seeing volatility now jumping 95, 100, 94, 99, no longer 100, 150, and 111, 116.
So you see the risk closer to 80 on the downside?
Yes. Yes, potentially. And now comes the big but, which is that the global reserve capacity, and we all know the countries here in Saudi Arabia and in the UAE, is so small, despite these safety walls in existence, that any even minor geopolitical incident, demand-side incident, fiscal stimulus in China, you name it, could throw the system up into a price spike. And that's why a bet on these sort of, for the rest of the year, declining trend in oil prices is rather risky. And that's why some people don't take it.
Prudent people don't take it. So then what was 100,000 add by OPEC? Was it symbolism to US politic pressure? Was it pragmatic response, given we've got limited spare capacity, which OPEC acknowledged? How would you describe the 100,000 barrel add?
It was a subtle gesture saying nice of the president to make peace and come by. Here's a little contribution, but the oil markets are not such that they require a big contribution. And it was a reminder to everybody that OPEC Plus has two goals. They like high prices as they are, and they want to keep Russia in the fold. And the very last thing Russia needs is low oil prices.
Well, let's talk about that, because do you think Russia held back, restricted the amount that was delivered at the OPEC meeting? Do you think that's part of the play? What do people tell you?
They don't deliberately restrict, but what we are seeing is a sort of cooling off of the high demand for cheap Russian oil in Asia, in India, and China. And we see in this three-way movement now. Remind you that by December 5, the European Union has promised it's stopping import from seabound Russian crude. And so what we're seeing is what we have been seeing for a long time: Russian crude being directed to Asia, Middle Eastern crude being directed to Europe, replacing it. What we are now seeing also is a surge of Russian product exports into the Middle East. Why is that? Because on February 5, there's an additional restriction coming in place in the European Union, not much talked about, which is a stop to the imports of refined products from Russia.
So this is the next round of sanctions. So they're blocked out of Europe, and they're diverting their flow here
crude
to the
oil being
Emirates.
embargoed December 5, products embargoed February 5. And now, of course, nobody buys oil to drink it, right? It's derived demand. So Europe needs products, not crude oil per se. It needs to be refined. And so now people are gearing up, setting a system in place. It's a three-way trade to replace these direct exports from Russia.
How bleak will winter get in Europe? Javier Blas's tweet this morning was about 1 year forward electricity prices being blown out of the water. Talk me through your version of winter in your homeland in Germany.
I don't think it will be that bleak as people make it out to be. You could despair, because when you do the translation, current prices today in France of electricity are the equivalent of $1,000 per barrel of oil, if you translate it. But I think what we're seeing is already a huge demand decline in natural gas, in particular in Germany, compared to last year. We are seeing Russia being really hurting. I just looked at the numbers. Russia, last month, July 7 to August 7, compared to 1 year ago, Russia's gas exports to Europe dropped by almost 70%, by 68%. And this is why they're now with the back to the wall. They know that this is lost, and is lost for good. And so one should not exclude the possibility that they will cut it off in the winter. And we're seeing the figures which say that the inventory filling programs in Europe, including in Germany, are bang on the 5-year average. And the problem, which is that even if they reach full inventories by November, that's going to tidy them over 2.5 months. And the winter in Europe takes 3.5 to 4 months, so they will still need Russian gas in that case. Whether that comes as dubious or not, but I can tell you just anecdotally from the little village where I was from, coming to you in Germany, I have never seen people building up so much wood in front of their little houses, and you can't get electric stoves and all that. Most importantly than anything, in opinion polls, way north of 70% of the population basically say bring it on, and back the plan of not importing more.
So bring it on, in other words, full blockade, don't capitulate, don't turn
on Nord Stream 2.
Don't turn on Nord Stream 2 very quickly, because we are running out of time. If we're at $1,000 a barrel equivalent of oil in France at the moment, Russia switches off the gas completely. We've only got 70% in the tank. How much of a squeeze comes to pass in the market? I mean, what are you looking at? $1,200, $1,300 equivalent in electricity?
The equivalent of electricity prices. But the smallest part, the second smallest part of natural gas consumption goes into power generation. Much more important, space heating. That's where the political factor comes in, because that affects households. And industrial feedstock. Germany, chemical industry, third biggest industrial sector. They need natural gas as feedstock for the industry. That has to be maintained even if households are freezing. And that's why the political support of the 70% of households is so important.
Okay, Christoph, I have this image of you out chopping the wood in the Black Forest and piling it high.
That will be the day. We only have a gas heater in an old house, 100 years old, not isolated, so I'm not going to be there in the winter.
Okay, Christoph's going to be with us for the whole of the winter. I think we can safely say he's got the golden visa now. Christoph Ruhl, Senior Research Scholar at the Centre of Global Energy Policy for Columbia University, my guest on the energy markets this morning. Let's get across to Jules. She's got the first word.
Thank you, Manus. South Korea's president has cleared the air to the country's biggest company of bribery charges. The move gives Samsung Electronics Vice Chairman J.Y. Lee the right to work at the firm. Lee spent 18 months in prison before his release on parole a year ago. Apple has asked suppliers to build at least as many of its next-generation phones this year as in 2021. That is despite worsening projections for the smartphone market. Sources say Apple is asking assemblers to make 90 million of its newest iPhone devices in a bet on affluent buyers and dwindling competition. Ping An Insurance appears to be unconvinced by HSBC's arguments against a proposed spin-off of its Asia operations. A source says the Chinese insurer believes the lender is in need of urgent and radical change. Ping An is HSBC's largest shareholder. The source estimates a spin-off would generate additional market value of $25 to $35 billion and reduce costs. Sales from electric vehicle maker Rivian rose to $364 million in the second quarter, well above analyst expectations. Rivian lowered its earnings guidance, however. The company saying it now expects to make a full-year loss of almost $5.5 billion. In a statement, Rivian blames ongoing supply chain constraints for limiting production. Global news, 24 hours a day on air and on Bloomberg. Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Manus.
Jules, thank you very much, Julia Tully, there in Singapore. Well, coming up on the show, we're going to take a look at the Russian economy. And after Christoph's conversation, what could the impact on the GDP be related to date? Sweeping sanctions expected to have set output back 4 years in the first full quarter following the invasion of Ukraine. The story with our chief economist for Russia on Bloomberg.
So what's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Or yes. Not keeping. Look, people have conviction, or they invest if they invest for the right reasons, just keep at it.
Griffin is moving both Citadel and Citadel Securities to Miami. The scoop was broken by Bloomberg's Amanda Gordon.
This is Bloomberg Daybreak Europe. Warm welcome to the show. I'm Manus Cranny in Dubai. So the Russian GDP figures will hit the tape later today, and they're expected to show a dramatic contraction. It follows the sweeping set of sanctions imposed by some countries on the Russian economy in response to Vladimir Putin's invasion of Ukraine. For more now, we're joined by Alexander Izkov. He is our chief economist for Russia. Alexander, good to have you. Welcome to Bloomberg. Welcome to the show. How bad is this set of data going to be? What's it going to tell me?
Depends on the perspective. I think so. Russia will contract around 5%. That's a lot. Russia's not a high-growth country, and this will shave at least 4 years of prior growth. But on the other hand, this is much less than people have expected when they imposed the sanctions. I think that this decline will put Russia on a trajectory of losing about 5%, about 3 to 4% GDP this year, and another 2% next year.
Just listening to the conversation I had with Christoph, talking about Russian exports of gas and of oil, yet you frame it in a way which is, look, man, this is nowhere near as bad as people thought it was going to be. And is that bolstered by high oil prices, high gas prices at the moment? But does that run out? Does that fade because they simply can't export as much at the original price? How do the numbers change over time?
The story is very different for oil and for gas.
Okay.
In gas, there's a dramatic decline in volumes. Russia now exports around 20% of what it used to export to the European Union, and this is 80% of the total natural gas exports. So the situation there is nothing short of dramatic. On the oil front, the situation is completely different. Russia found outlets to sell most of the oil which used to go to Europe. So oil exports and recovery in oil extraction supports Russian growth.
Now, the longer-term prospect, I think you very clearly delineated there. Look, it's the implosion of the gas exports that has been perhaps the most pain. They're finding buyers for Russian oil. But as you look on a longer-term trajectory, we don't know where the end of this war is, and we don't know how long Russia will be in the cold, so to speak. What do you see as the longer-term prospects for Russia?
They essentially, as for any other country, break down into productivity growth and demography. Productivity growth in Russia has been underpinned for the last 20 years by Western investments. New plants, new manufacturing, etc., and that is gone. What is left is demography, which is also not very good for Russia. So our projections suggest that 1% annual growth is probably the maximum achievable growth rate for the years to come.
Okay, let's see what the data gives us a little bit later on today, Alexander. Thank you for joining me around the desk. That's Alexander Izkov, our new chief economist for Russia. Coming up on the show, good inflation reading for July. It's welcome news, but the fight against a rapid price rise is far from over. Mary Daly's interview on Bloomberg.
A digital-first approach to the future of work is where the industry and all companies will be heading.
Could the future of work not be at home or in the office, but in the metaverse instead?
There's that word, metaverse.
Doing well. How are you doing?
When I think about the metaverse, I think about immersive experiences that have a sense of active presence.
Wow, look at this. This is me. The metaverse is projected to become over $1 trillion market by the end of this decade. And whether you know it or not, you'll probably be working there in the future.
We're moving into a world where we're going to be interacting with computers with our bodies.
This is definitely trippy.
I think the adoption curve is going to be slow.
It's
doing
weird.
like a weird floaty thing right now.
Oh, look at you. You have no legs.
It's kind of a fun world, and we're just at the very beginning of a very long journey. We will never break. We will never break. Build on a foundation strong enough to stay. We will never.
The scale of 50-75 doesn't just depend on a data point, even an important one like the CPI. I like to say that we're data dependent, we're not data point dependent. And so really how I think of whether it's going to be 50 or 75 is I look at a lot of things coming in. So we have inflation numbers coming in, we have employment numbers coming in. We actually spend a lot of time, I know I do and my colleagues do, talking to businesses, households, community groups, people in stores. What are you feeling? And are you seeing signs that the economy is slowing? So all of those things, when I put them together, global risks, global growth, I have a baseline case going into September that is 50 basis points. That's where I've been since the last meeting. But I have an open mind about whether 75 is going to be necessary. And a lot of that will depend on the labor market, inflation, and whether we start to, we see those things slow enough to say, wow, we've got the momentum we need to really fight inflation.
But 50 or 75 isn't about pivoting. It's not about ending this rate hike path. So I'm still kind of curious, if you just were looking at those numbers, what would you say? Do they support your baseline, for example?
So 50 or 75?
Yeah.
I think 50 supports the baseline. Think about where we need to be at the end of the year.
the numbers we just got.
Oh, the numbers we just got? The numbers we just got say that we have enough uncertainty about the path of inflation. It looks a little bit improvement, but we don't want to be head fake, so we want to wait for the next report. We have an inflation report and an employment report coming out before the next meeting. It really behooves us to stay data dependent and not call it. But for today, with those numbers in hand, I still think 50 basis points is the case, but I am open to 75 should the data evolve differently.
So we've got another inflation report, another jobs report.
We do, indeed.
Now, I want to ask you, I want to hit some of the big points first. And the other one is, there's, in terms of recession and recession risk, there seems to be frequently a sense in markets that, oh, once there's signs of a recession, if the risks are rising, the Fed will pull back. So is the Fed, are you willing to let those risks materialize if you have to risk a recession, if that's what it in the end takes to get the inflation rate down?
Well, I'd like to start with this. We are a long way from evaluating those risks. Right now, look at the employment report. People in the labor market, whether they're a firm trying to find a worker or workers trying to find a job, do not feel like it's a recession. Right now, jobs are plentiful. The main marker for consumers about a recession is, are they finding a hard time finding jobs? Is it hard to get a job? And are their incomes falling? And you really don't see that right now. So I don't see the risks of inflation as our preeminent risk. I see the most important risk we face in the economy as inflation is too high and has been too high for too long, and we need to bring that down. So when I'm balancing the risks, I'm really balancing how quickly can we bring inflation down without tipping the labor market over, and that's why 50 basis points makes sense to me right now.
Mary, does the stock market bullishness right now, is that challenging to the Federal Reserve, given that, of course, that could relax financial conditions, which is not what the Fed wants to see at this moment?
So we look at a broad range of financial conditions, and the stock market is simply one of them. I'm also looking at mortgage interest rates and borrowing rates for businesses and consumers for a variety of things. And I really do want those to remain tight and tightening as we go, because we don't want financial conditions to relax. We want them to remain tight so that we can continue to bridle the economy somewhat, take the accommodation out. Remember, financial conditions have been so loose, in part because we were adding a lot of accommodation to get us through the pandemic. Now we want to pull that back, and we want the economy to slow, bring demand and supply back in balance, and deliver a sustainable growth path that delivers on price stability and full employment. This is achievable, but it takes some time to work its way through.
Mary, it's not the ideal scenario, but would you ultimately be comfortable or okay with triggering a recession, even if it's a mild one, in order to get over inflation?
Well, let me just say what is true is that I think about what I want to achieve, what Americans really are expecting us to achieve, and that is a smoother transition that doesn't require a recession, actually delivers on a slower economy that is still giving people the jobs they need and the price stability they deserve. That's what I'm looking for, and that's what I'm focused on 100%.
Mary Daly there. What a great way to put it. Doesn't want to see a head fake in terms of jumping off on one data. Let's get to Lizzie. She's standing by. What are the numbers? What are we looking for on GDP? Lizzie.
Well, Manus, it's less than 5 minutes now. We're expecting a 0.2% contraction in the second quarter. That's because of the decline in health output, the fact that the cost of living crisis is likely to have bit into retail spending, and mostly because we had that extra bank holiday in June. And if it hadn't been for the upswing in the third quarter that we're expecting, because there isn't a bank holiday then, the economic pain that the Bank of England forecast last week, the long but shallow recession, really would have been starting now in the second quarter. So what this figure will mean for the Bank of England, well, if it's a smaller hit to GDP than expected, it'll add to the Bank of England's argument for a 50 basis point hike in September. But really, we're looking forward to the jobs and inflation data.
Thank you very much. Let's see what the data is when it hits the tape. Our Bloomberg Markets Europe is up next.
The standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that.
Yeah, exactly.
And then the fund is typically lasts maybe 10 years or so.
15. Well, these days it's longer, so often 15. Often the tail extends out to 20 years. These companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
You know, top-end venture is sort of 3x net of fees. You know, ideally you're hoping for more than that. You're hoping for 5x or more. You know, you're illiquid the entire time, right? So you would hope to get paid for the liquidity.
And today,
so yeah, maybe 20 to 40% if things go well is sort of baseline.
Let's take another subject, because let's suppose somebody says, I don't want to invest in Andreessen Horowitz, I want to be Mark Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? Is it high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie? What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different. Jim Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences. And so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Bloomberg Green, bringing you the business, data, and innovators fighting climate change. Reinventing climate news on TV, Quick Take, and Bloomberg.com.
Well, good morning, everyone. Welcome to Bloomberg Markets Europe. I'm Francine Lacqua live in London. Mark Cudmore, our Markets Live managing editor, also joins us from Singapore to take us through all of the market action this hour. The cash trade just less than an hour away, and here are your top headlines. Cooling down, well, a key measure of U.S. producer prices unexpectedly falls, but the Fed's Mary Daly is not ruling out a 75 basis point hike next month.
I have a baseline case going into September that is 50 basis points. That's where I've been since the last meeting. But I have an open mind about whether 75 is going to be necessary.
Contraction concerns. UK GDP figures are out shortly with expectations for a drop in economic activity. Plus, the Washington Post reports that the FBI was looking for classified documents on nuclear weapons in the search of Donald Trump's presidency. So welcome to Bloomberg Markets Europe, everyone. Just on 7 a.m. here in London, a lot later in Singapore. And Mark, what are you looking like in the markets?
Good morning, Francine. Well, I have to say, there's not been much fundamental news. Yes, we had PPI out. We already got the big CPI print. But I am getting a little bit worried by the price action. I'm concerned by quite how negatively we suddenly sold off yesterday. And it does seem like the market is kind of not maybe going with the script of like a low vol August that I was hoping for. I was really hoping to switch off the next couple of weeks, but it looks like we may have to stay awake after all.
I know that no big catalyst, which is probably why you're a little bit worried. I really want to hear more of your thoughts on what we should be looking out for next. We're also getting marks of GDP figures out of the UK. Year on year, it's 2.9 instead of the 2.8 we were expecting. Quarter on quarter, minus 0.1 instead of minus 0.2. So because this is backward looking, Mark, I wonder whether it'll have any impact on markets.
Yeah, look, I think what's really interesting about this data is that, like, look, it's a pretty poor print across the board, but I'm always mentioning the high-frequency stuff here. And a lot of the high-frequency stuff hasn't fallen as much as expectations. So you've got manufacturing production, industrial production, all lower, but they're not down as much as was expected month on month. And in fact, and the year-on-year numbers have come in better. And what's interesting, and I always like looking at this in the high-frequency stuff, is across the board, industrial production, manufacturing production, and construction, all of them, the revisions are higher. And I think that is quite interesting. So overall, this is actually a pretty strong data set. I know people focus on the GDP headline number, but I think the rest of the data is actually pretty strong relative to expectations.
So we're just under an hour away from the start of cash equity trading in Europe. If you look at the futures, and this is the one thing that I know you're worrying about, right? The move yesterday that we saw, Mark, overall. European stocks pretty much flat. DAX futures also pretty much flat. I wonder whether now it's really all about the Fed, whether they capitulate if the labor market slows abruptly, and then if there's a swing now that, non-farm payrolls, the unemployment rate actually more important than inflation. That's probably the question I want Mark to help me with. Overall, if you look at U.S. futures, they're also on this sideways moves after the concern we had yesterday. They're gaining some 0.3%. I guess, Mark, it's all about looking forward, right? So if they're looking forward to declines in interest rates as growth ease and pricing that in 2023, then yesterday, I can't really explain, like you, the market moved yesterday, right? Or are they just taking stock and trying to figure out what it means? And so confused, or is it August liquidity?
That's a good question, Francine. I mean, one of my central rules is don't read too much into the short-term price action in August because it is summary liquidity. We do have less participation, and you do get a few erratic moves. But I am a little bit worried about that price action. One thing you mentioned there, Francine, was about this idea of lower interest rates in the future. We're not getting lower interest rates anytime soon. The whole idea of a pivot next year is completely bonkers. We can argue about how high the Fed will hike rates, but when they get up there, when they get to 4% or potentially much higher, they will stick there for some time. Looking at the GMM, the real standout is Japanese stocks, but you've got to remember they were off on Thursday. So this is really just a catch-up to what we've seen elsewhere. And I think that's important context that, yes, we did see that stocks kind of trade a bit weaker late in the US session yesterday. It's not been a particularly enthusiastic session out of Asia, but on a two-day horizon, most stock markets are up a lot, and you can kind of see that with the Japan, which is trading the two-day version because it was off on Thursday. Otherwise, seeing the dollar a little bit softer again, which is pretty interesting. And again, we're seeing yields a little bit higher. This idea that, hey, we're not really kind of buying this idea that inflation is turning just because it might have peaked. And I think that is the right conclusion. Interestingly enough, commodities are higher yet again, and they're really trading quite well now again in the last week or so after a pretty terrible kind of period in June into July. And I think that's also getting people worried on the yield side that, hey, commodities, the source of this original problem, are starting to look perky again.
Yeah, so Mark, how would you characterize it? I know we have that PPI, that everything feels hot in terms of the economy, in terms of inflation, but I guess the direction of travel is what, a flattening out maybe of that, and the markets are trying to figure out what that means for prices.
what we're doing now is we're just erasing some of the excess inflation from the pandemic. But the point is that across all inflation measures, a very, very broad level of inflation that seems to be about 4 or 5% around the core level, maybe a little bit higher. And that's why I think we've got a very, very deeply entrenched level. I think we're going to really, really struggle to get inflation below 4% without a deep recession. And that's why, to me, I think 4% is the floor for Fed yields. I actually think that it's more likely the Fed ends its cycle on a 5% or higher handle than it does on a 3% handle. I think the idea that they'll stop before 4% is absolutely crazy. It requires a major collapse in the economy coming soon. And I just don't see that. The consumer is spending, the jobs market's still pretty strong. And yes, we're seeing a slowdown, but we're seeing a slowdown from incredible strength before.
But at 5%, Mark, that's a real reckoning for equity and bond markets.
Completely, but if you tell me that, okay, it might be 6%, fine. My point is that below 4% just seems crazy. We have a floor of inflation. I just don't see how we're going to get inflation back below 4% without causing that recession. And so you're not going to cause that recession unless you tighten financial conditions. If we try to stop, or if the Fed tries to stop policy at like 3.5%, 3.75%, all they're just going to do is fuel a bigger inflation problem. We're going to go back into the 70s, where we keep on thinking we've tamed it because we see a peak, and we don't understand that doesn't actually bring inflation down. And then you get really, really stuck inflation expectations. And if we do make that massive policy mistake at stopping yield rises at 3.75%, say, and thinking that will be sufficient, well, then we're ultimately heading for a Volcker moment in a few years' time, because we will have created a much deeper inflation problem.
So, Mark, I wonder whether we need to talk less about inflation. I mean, I know we talk about inflation all the time, but we really need to look at the labor market in the U.S. because the longer the labor market holds up, the more aggressive the Fed will be.
I think that's right. I mean, I'm hearing a lot of people saying, look, it's time to switch to the jobs market because inflation has peaked. Maybe, I think both are still important, but I mean, in the same way that, I didn't too worry about the inflation peak, it's about how sticky they are. The jobs market ultimately is going to be very important for when the Fed will kind of realize they can ease off a bit. But at the moment, it's so hot. We're near record unemployment levels. So I think the jobs market needs to ease a lot from here before we really start caring about a tipping point. So actually, I'm not that excited about the short-term jobs prints. To me, it is still about the breadth of prices in there.
Mark, away from a big catalyst, and I know we have Jackson Hole, as you say, the next big event, August 25, what do you think markets will be looking at?
So we do have Fed minutes next week. I think that'll be interesting. I think that there's a chance that it probably comes across as maybe towards 50 basis points in September, but with optimism that they are data dependent. But I think the rest of the message will be hawkish. And I think, again, it will kill that idea of a Fed pivot next year, which we are still pricing and I think seems absolutely crazy.
Yeah, Mark, I can't wait to have more market thoughts. And of course, you can also join the conversation. We have a great MLive blog going on with Mark and the team on it. I also am a new subscriber, and it's fantastic to our breaking news macro review newsletter. And I have to urge everyone to go on and actually be part of it. I'll push it out on social media. Now let's get straight to the Bloomberg First Word News with Alice Atkins. Hi, Alice.
Morning, Francine. Bloomberg's been told President Biden is getting ready to launch his re-election bid after November's congressional midterms. It sets up a potential 2024 rematch with Donald Trump. Polls suggest most Democrats would prefer a different candidate. Those close to Biden say he's committed to stopping Trump from returning to the Oval Office. The frontrunner in the race to become UK Prime Minister has ruled out levying a new windfall tax on energy companies if she wins. Liz Truss said doing so would send a wrong message to businesses, international investors and the public. Her rival, former Chancellor Rishi Sunak, promised to find up to another £10 billion to help people pay for soaring energy bills. Hong Kong's population has fallen by a record 1.6%, with more than 120,000 people leaving the city in the past 12 months. That's the third straight annual decline, leaving the population at about 7.3 million. The government cited strict COVID restrictions as a factor in the drop. Separately, a Bloomberg survey shows Hong Kong's economy is expected to show little to no growth this year. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Francine.
Alice, thanks so much, Alice Atkins. In London, coming up, the FBI searched Donald Trump's residence for papers on nuclear weapons. That's according to the Washington Post. We'll have all of the latest ahead. Plus, we'll break down the GDP data from the UK and get the thoughts of Legal & General's Chief Executive Nigel Wilson. That's at 7:30 a.m. London time. Plus, next, we bring you that conversation with the Fed's Mary Daly and discuss the central bank's path forward with Ella Hochschild from Pictet Asset Management. If you have any questions for any of our guests, please send them to us on IP Plus TV Go. This is Bloomberg.
There is an epic saying in Italy when it comes to family generations that the first generation creates, the second generation expands, and the third generation destroys. And that's almost what happened in the Gucci story.
So hate and love together. Now I would have a much more experience about for those who says I love you and then betray you.
The Gucci family was the strength, but also the weakness of the label.
The situation became dire with Gucci's finances. They were not able to pay salaries. They were not able to pay suppliers. Gucci's really teetering on the brink at this stage.
We have to be able to give our customers vehicles, that are their primary vehicles that are EVs, and to be able to do that, we need to have range and infrastructure, and we need to remove the pain points. And so that's what we're doing.
the scale of 50-75 doesn't just depend on a data point, even an important one like the CPI. I like to say that we're data dependent, we're not data point dependent. And so really how I think of whether it's going to be 50 or 75 is I look at a lot of things coming in. So we have inflation numbers coming in, we have employment numbers coming in. We actually spend a lot of time, I know I do and my colleagues do, talking to businesses, households, community groups, people in stores. What are you feeling? And are you seeing signs that the economy is slowing? So all of those things, when I put them together, global risks, global growth, I have a baseline case going into September that is 50 basis points. That's where I've been since the last meeting. But I have an open mind about whether 75 is going to be necessary. And a lot of that will depend on the labor market, inflation, and whether we start to, we see those things slow enough to say, wow, we've got the momentum we need to really fight inflation.
But 50 or 75 isn't about pivoting. It's not about ending this rate hike path. So I'm still kind of curious, if you just were looking at those numbers, what would you say? Do they support your baseline, for example?
Oh, the numbers we just got? The numbers we just got say that we have enough uncertainty about the path of inflation. It looks a little bit improvement, but we don't want to be head fake, so we want to wait for the next report. We have an inflation report and an employment report coming out before the next meeting. It really behooves us to stay data dependent and not call it. But for today, with those numbers in hand, I still think 50 basis points is the case, but I am open to 75.
Well, that was the San Francisco Fed President Mary Daly speaking to Bloomberg TV about the outlook for rate hikes in September. Well, joining us now is Ella Hochschild, Pictet, Senior Investment Manager for Global Bonds. Ella, thanks so much for joining us. When you look at inflation expectations, so the trend or the direction of travel in the U.S. is that it could have peaked. How significant is it compared to the hot economy we're still seeing?
Yes, of course, we had
contact demonstration model in which two parts are being pressed together with a pressure load. The load is applied to the top surface of this object, and it then presses into the second block object such that the right end makes contact with the block. Be in contact. For example, with the option to create contact boundaries. The simulation and compute assembly. To find out more about how contact pairs should be defined, please refer to the Structural Mechanics User's Guide.